Last week, we saw a very notable, if not somewhat stealthy, development within the precious metals markets. While lots of financial news media ink has been spilled in recent months on the incredible strength and new all-time highs in gold prices, less attention has been paid to its cousin, silver. Indeed, the price of silver has lagged the pace of the price of gold over the last year and a half or so, and silver still remains considerably below its own all-time high of just under $50 an ounce, set back in April 2011. However, last week, silver broke through an important resistance level of about $35 an ounce. The key question is this just a head fake, or is silver now destined to outshine gold in the weeks and months ahead? Hey everybody, John Lodra here. Thanks for joining me today. I'm a certified financial planner and co-founder here at New Harbor Financial Group, a firm that my partner Mike Preston and I founded over 20 years ago after leaving a large international financial services firm. One of the reasons we founded our independent firm back in 2005 is that we observed emerging excesses and fragilities in the financial system that the mainstream financial industry seemed all too willing to downplay or even turn a blind eye to. We saw the increasingly loose monetary and lending policies that emerged in the wake of the tech bubble way back in the early part of the century as a brewing problem. And our concerns led us to increasingly suggest our clients consider real assets, especially precious metals, gold and silver, as a potentially important hedge and portfolio diversifier. Little did we know that the ensuing housing bust and great financial crisis would unleash the most extreme monetary policies in history, with the Federal Reserve and its global peers printing literally trillions of dollars of base money out of thin air in successive rounds of novel sounding policies like Operation Twist and quantitative easing. Fast forward today with lingering concerns about sticky inflation and ballooning fiscal deficits here in the US and abroad. The appeal of precious metals in a properly positioned portfolio has persisted and even grown, not just for savvy retail and institutional investors, but the world's central banks themselves. Indeed, central banks have purchased record amounts of gold as part of their reserves policies in recent years, and surveys by the World Gold Council have indicated that these trends will likely continue in the next few years. With that in mind, it should come as no surprise that even though the stock market itself has nearly returned to all-time highs, leaving the market weakness we just saw a couple months ago in April as a seeming distant memory, the return on gold has outpaced even that of the S&P 500 since the tech bubble peak way back in March of 2000, a full quarter century ago. It's with that backdrop that I'd like to discuss the recent strength and breakout in silver and what that likely portends for the direction of silver ahead. This video picks up on a comprehensive video covering both gold and silver that my business partner Mike Preston released about a month ago. If you didn't catch that video, check it out by hitting the link here shown here in the video window. But for now, let's jump right into a deep dive on the action and the dynamics of the silver market and what the future potentially holds for silver prices. I would like to share a chart that shows, going back to April of 2006, the price of both gold and silver on the same chart. This actually is a chart that looks at the prices of two ETFs, two very popular ETFs, GLD for gold and SLV for silver. Not a recommendation for these particular ETFs, just an illustrative chart of the price history. The candlestick chart here, these green and red bars, is the price of SLV, silver. The line, the fuchsia line here is the prices of GLD, an ETF that tracks gold bullion. So what you saw here in the lead up from April 06 to 2011 or so, silver had a much more extreme ascension than gold, even though gold did quite well itself. But then both of them dropped in the years that followed, and silver more spectacularly so, of course. And what we saw is both silver and gold traced out many, many years here from, let's call it 2013, 2012, right up to 2020 or so. This kind of sideways to kind of cupping action here. Very frustrating time to be a precious metals investor or investor in companies that mine precious metals. But then in 2020, in the wake of COVID and whatnot, we saw a pretty sharp rally here in precious metal prices. And in fact, silver prices rallied quite a bit more dramatically than gold. But then we petered out a bit and we saw gold prices and silver prices trade sideways to down, especially in the case of silver, down. And it wasn't until 2024 that both silver and gold prices started an ascension again, and gold especially outpacing silver prices. You can see that in this chart here. So you can see gold prices have reached, well beyond their highs of 2011. They're at all-time highs now. On gold, we tagged nearly $3,500 an ounce. We're just around 3,400 thereabouts today. So just a little bit off the all-time highs. And silver has yet to regain its all-time highs again. In April of 2011, silver reached just below $50 an ounce. SLV is a little price basis difference, so it's not quite near 50 there. It was 48 on SLV, but we're now about silver broke out above $35 an ounce, so still quite a bit below its nearly $50 an ounce price in 2011. We think this breakout of 35 is a very meaningful breakout, and we think silver may actually be poised to outshine gold, excuse the pun, in the months ahead. But before we do that, I'd like to go through and just cover some of the specific nuances of the actual differences between the silver and gold market. So first of all, the silver market is a much smaller market than the gold market. Generally speaking, institutional players, large institutional players are big players in the gold market, where they're not so much in the silver market. Silver tends to be more predominated by smaller retail investors, and arguably it's a more susceptible market to manipulation or volatility because of the smaller size of the market. This harkens back to the infamous Hunt brothers fiasco back in 1980, where two brothers, the Hunt brothers, basically cornered the silver market, or attempted to corner the silver market, and prices shot way up, and only to come crashing down as they got investigated by law enforcement for unfair trading practices, essentially. So that's a distant but very profound memory in the silver market go back in 1980. Now, from a physical purchase standpoint, silver is a much bulkier proposition than gold. Just given the price differences per ounce. Silver, again, close to $36 an ounce as we speak here today, just having broke out through that $35 level. Gold closer to 3,400. So for the same amount of ounces of product, you need much more silver. So it's a much bulkier thing to store. Whether someone's storing things at home or in a safe or a vault where you got to pay storage fees, silver tends to be a little bit more problematic and more bulkier and costly even to store. The other big factor is gold is very much a viable and credible asset for central banks themselves. In fact, there's July 1st, the Basel III Accord or rules, basically make gold a tier one asset. So it's becoming a much more legitimized asset even in the banking sector itself. But if you look at the reserve practices of the world's central banks over the last few years, they've been buying record amounts of gold. And surveys by the World Gold Council, for example, shows that that's likely to continue, as I may have mentioned earlier. So that's been a factor that has been driving gold prices, perhaps causing them to be much stronger than silver in recent months and even the last year and a half. The other very large factor, and we think this has probably been a huge factor so far this year until recently, is silver is driven much more by industrial uses than gold is. And thus, it can be much more influenced by economic activity and slowdowns or perceived slowdowns in the economy than gold. So here are a couple charts that have been put together, and the source data is the World Silver Council. The pane on the left basically breaks down global demand for silver by different sectors or kind of sources of demand. And what you see here is the by far the largest component of demand is from the industrial sector. That's the gray part of these bars. Compare that with, for example, the coin and bar purchases, which is the orange. Much smaller portion of the total demand. So the silver market is very much influenced by demand of the industrial sector. Now you can see that demand in aggregate has increased quite dramatically over the recent years. You see the price of silver, even though it's been a laggard relative to gold, more or less over the last handful of years, in its own right has risen quite nicely, from a low of 15 back in the 18-19 area to above 30. So that's no slouch of return for silver prices itself. The pane on the right, I think, is really interesting because it shows the changes in demand by sector. So what you see here, comparing 2023 over 22 and 2024 over 23, You see almost every sector has stagnated or declined except for the industrial. You can see massive increases in industrial, again, because of the sources of demand from those industrial sectors. And you've seen actually some reduction in demand from coins and precious metal only investors. Now, the pace of those declines has moderated somewhat in 24 compared to 23 as compared to 23 to 22. So it would not be surprising to us if we see that demand start to pick up again, especially with the price action in silver of late. The next chart kind of gets into a further decomposition of the industrial demand. So you see photovoltaics had by far the biggest point-to-point rate of increase. This is from 2016 through first part of 2025. Nearly 140% increase in demand from photovoltaics. But then you have things like electrical and electronics, a very healthy 19% annualized demand. Between the two, we're talking about a 50% increase in growth. Other industrials, nearly 20% growth over that time frame. And importantly, other sectors we've seen some moderation. Silverware, that's actually declined. Coin and net bar demand has declined. Clearly, the industrial influence is quite dramatic. And we see total supply has increased and mine production has stayed rather stable. Becoming more and more difficult to mine this. Mines are becoming less productive and more expensive to find. So we have what we call a classic sustained imbalance of supply and demand. And that's what this chart on the right shows. It basically shows that for the last 4 years, demand for silver has outstripped the incremental supply. So we've been running these deficits. And the Silver Institute is projecting that 2025 will be the 5th straight year of deficit. That's more or less unheard of. So there's a very profound supply and demand imbalance that we think will be a persistent tailwind for silver prices going from here. So I hope that was a helpful illumination of some of the unique aspects of the silver market relative to the gold market that in part can explain some of the lagging of silver. The whole industrial component, I think it'd be naive to think that the whole uncertainty regarding tariffs and trade policies that have been unleashed for much of this year by the Trump administration has put a dent in the demand and projected demand for electronics and things like that. Now, ironically, I think even though that picture is still very murky, I think the market is probably starting to read a conciliatory tone there in that even if there are tariffs and even if there are trade tensions that persist, they're likely to be far less oppressive than originally feared. And that in itself, not great news, but far better than what was originally perceived, I think is going to be a potential tailwind for silver prices in the near term anyways. We'll see how that plays out, but that we think is a moderating factor that can explain some of the recent strength in silver relative to gold. So in that regard, I wanted to pull up a couple of charts. One of the hallmarks that we use in our investing styles is this concept called relative strength. It's simply a systematic way to measure the price action in one asset versus another. And it's very helpful to look at that history as relates to gold and silver. So this is a chart that goes back to 2014. You can see along the horizontal axis here at the top are the years. Now this is what's called a point and figure chart. So unlike many charts, the scale on the axis, the x-axis, is not linear. That's why you see different widths between these years. They're not a straight passage of time, the movements up and down in price. And in this case, the relative prices between gold and silver dictate the spacing between the years. So what this chart is, it's a comparison of GLD, that same gold ETF, the prices of that versus the prices of SLV, that silver ETF we just talked about. And basically, when you see a column of X's here, it means that the prices of gold relative to silver are increasing at a faster rate or decreasing at a slower rate. The relative performance of gold is better than the relative performance of silver. They could both be going up, but gold could be going up faster, or they could both be going down and gold be going down slower than silver. And that's where you get a column of X's. For example, we'll see these big periods where gold will ascend much more quickly than silver. But then you oftentimes see these reversals into columns of O's. And that's when the baton is passed over to silver to outperform on a relative basis gold. And what you can see here is that with the action of recent days and really the last week or so, we've seen that signal not only turn into a column of O's, but we've registered what we call a relative strength signal here where that prior column of is taken out. So this is a very encouraging short-term, if not uncertain picture for silver. What we notice if we go back in history, oftentimes when there is a column of O's that registers a signal here, meaning silver has regained strength relative to gold, we oftentimes see follow through. So you see one signal here, you see another here, and so forth. You see back here in 2020 when silver, did far better than gold on a relative basis. You see these consistent success signals. Too early to tell if we'll see a series of successive signals here in favor of silver, but the early picture is quite encouraging. One way that we look at the relationship of the gold and silver market beyond the relative strength chart I just shared there is this concept called the mint ratio. And it's simply looking at the ratio of gold prices relative to silver prices. So here you see this goes back to the early 1995 timeframe right up through the present. And you can see that very recently this mint ratio, the ratio to gold to silver, got just above 100. It's rarely ever done that. In fact, the only time it did that was in the lead up just prior to 2020. And in fact, if you look at this long-term chart, you can draw eyeball a line here that, probably on average, we would see this closer to 70 if you go back over this long range chart of 30 years. If you look more recently in just the time since, let's call it the early 2010s, maybe it's closer to 80. Right now, we're not, we've pulled back because of the recent strength in silver. This ratio has moderated a little bit, but it's still above 90. So even if silver stays, even if gold stays the same, or even pulls back a little bit, there's still room for this ratio to moderate down closer to 80 or even 70, which would mean that silver is continuing to outperform. Now, a key question here is what happens to gold prices? We actually think gold prices are poised here to continue to rise. And that would, I think, on a relative basis, just give that much more incentive or a reason for silver to continue to rise and perhaps at a faster pace than gold. Lots of veteran investors out there have been talking about the importance of gold. People of the likes of Ray Dalio. And a lot of the reasons that are being pointed to this is this fiscal train wreck that we have here in this country. And it's not, new with the Trump administration. This is something that's been growing, frankly, over the last several administrations, including the Biden administration. So it's an equal opportunity scenario to bash our politicians of all stripes because the deficit spending has gotten concerning, and there is no credible view in sight that will get better. So many people have talked about forecasts of, say, $4,000 gold in the not too distant future. We're currently around 3,400, give or take. That's nearly 20% higher from here for gold. So we do think not only does silver have bright prospects, but gold itself continues to have bright spot prospects, and the relative move in gold we think could be higher. If we had to put a target, we think in the intermediate term, silver could hit $40 or $45 an ounce. That's 10 to say 25% higher than where we are right here. Of course, there's no guarantee. There's always the possibility for pullbacks along the way, even if we do go to those higher prices. Longer term, we've seen forecasts of silver getting as high as $100 or more. And we think there's credibility to those forecasts, especially in a scenario where central banks return to things like massive money printing and QE or the fiscal spending that we just talked about continues or gets worse, this reckless path here in the US and abroad. Right now, the markets and the trends are telling us that there's very much momentum on the side of both gold and silver, but lately that momentum is starting to look a bit more emphatic for silver. So in summary, very encouraged by the recent action. In fact, we did just recently add a small slice of silver to our client portfolios in a silver bullion ETF to the tune of about 2.5% of our client portfolios. That adds to about a 10% allocation to gold mining stocks that we've held for clients for some time. But as encouraging as this action has been, it should go without saying there's no guarantee this will continue, and that pullbacks or even a trend reversals is always a possibility. It's really a matter of probabilities. In our assessment, the recent action just has shifted notably, I think, in a positive way, the increased probability for follow through to the upside over the near to intermediate term. So with that, I'd like to just leave you with some final thoughts and advice as it relates to precious metals investing in general. We've long suggested that a 5 to 10% allocation to physical precious metals can be a prudent move for folks, even if it's a form of insurance policy against things like, fiscal irresponsibility, devaluation of the US dollar, which, by the way, the US dollar has been quite weak, and that trend continues, at least in the near term. If we had to give broad guidance, we generally say maybe hold about 2/3 in gold and 1/3 in silver. This would always be considered in the context of your own financial situation. Beyond that, we think paper bullion or mining stocks can be very suitable investments in the right amounts in your brokerage accounts or IRAs. It's got to be based upon your own personal situation and overall financial plan. And like anything, too much of a good thing can be a bad thing. Right now, we have, again, about a total 12.5% allocation of precious metal type investments in our client accounts. Precious metals can be volatile asset class, and silver even more so than gold, given the smaller size of the market. And sometimes that very volatility can be a benefit because, generally speaking, gold and silver tend to be on or non-correlated or lightly correlated with traditional financial assets like stocks and bonds. So even though they may be more volatile, the coincidence of that volatility may be exactly offsetting to the same movements, but in opposite directions as traditional stocks and bonds. So that's a very important thing to keep in mind. And excuse the pun, but there is no silver bullet. While gold and silver can be effective in a wide range of scenarios that I've already talked about, there are times they can struggle, such as massive deflationary environments. We're not in one of those right now, or periods of rapidly rising interest rates or rapidly strengthening dollar, none of which we see right now. As I mentioned, the dollar's been quite in a sustained downtrend. But it's most important with any kind of investing. It's important to be adaptable. The trends for precious metals are favorable right now. Be open to those trends reversing or shifting and taking defensive actions, including hedging, trimming, or even exiting your paper precious metal investments if the market trends warrant that. So I hope you found this helpful. Please feel free to share this with folks you think might benefit from this. It's a confusing market for many, and hopefully I've shared some useful information here. We very much invite your questions and comments. Please like and follow this video, subscribe to our channel. We put video content out nearly every week on a whole host of things, both investment related, financial planning related, and everything in between. Tell us what you'd like to see. We'd like to cater to what you want to see in our future videos. So for now, I just want to thank you for watching, and until next time, I want to wish you a great day.